and sell some puts to make it a really cheap trade to do.
Yeah.
So, a trade that normally, had you just bought calls, they would have cost you, let's say, 50 cents. But if you do a call spread, it's now cost you like 10 cents because you've capped some of your upside. And then you sell some puts at way out of the money for 5 cents, and the whole trade costs you 5 cents. And then if it does go up, you make like 20 times your money. And they did this trade every year. And it works because the seasonality is so strong at the end of the year. And when you've got a year like this one, where we've got liquidity that needs to come into the market, but more than that, everybody's underweight tech. I mean, the surveys come out from like Bank of America all the time. It's like everyone's underweight tech. And so we know the year-end window dressing means I need to buy tech.
Hey guys, welcome to Everyday Finance. If you've been keeping an eye on cryptocurrency lately, you've undoubtedly noticed what everyone else has. Hardly much is moving. Stablecoin growth has hardly changed since the summer. Altcoins are slow, and Bitcoin is stuck. The market feels worn out, unsure, and aimless. The bull run is over, according to headlines, which attribute this to everything from waning ETF enthusiasm to whale sales to world unrest deterring new investors. However, Raoul Pal contends that the cycle is not over. It's just the silence before the big move. Pal, the CEO of Real Vision and a former Goldman strategist, claims that the market is simply running low on liquidity rather than imploding. Crypto's momentum has been momentarily depleted by problems with the government budget, its unstable financial markets, and investors shifting their investments to gold and technology. However, a lack of liquidity at this point does not indicate that the cycle is over. It indicates that the spring is being twisted firmly. His key argument is that this cycle will not peak on the typical 4-year halving rhythm. He predicts that the true manic phase won't occur until 2026. The rationale is that global money flows. The same dynamics driving gold. Bonds and stocks are driving this cycle, more so than halvings. Powell thinks the strongest stage of the bull market is still to come because of the trillions of dollars in debt that are rolling over, the anticipated rate reduction, and the significant balance sheet expansion that is ahead. In today's analysis, we'll examine Powell's revised perspective, the reasons behind the market's sideways movement, how liquidity influences the entire cycle, and why 2026 might be the year that Bitcoin and digital assets undergo a radical transformation.
It's like the total three, so that's excluding Bitcoin and ETH.
Yeah.
Right, so we still haven't gone through where we were peak of the prior cycle. And it's been a slow crawl versus a speedy ramp. And this is because I think it's to do with the debt maturity got extended. So this is like a weird mid-year. Yes, I did imagine it was going to break this on this occasion. When was that? July?
Are you sharing? I don't know if I can see.
You're not
I don't think I can see it if you are.
I am sharing.
There you are. There you are. We can see it now.
I thought in July it was going to break through. Not that I'd do anything about it. And then it had the big puke. But really, a pattern like this usually means that we will eventually have what we want. But it's the patience that's tested everybody. Because this has been a long period where a lot of this stuff has not gone to highs. And even then, it was January that everything else was at its highs, like SUI and everything else. And so everyone's been waiting 11 months or 10 months to have anything.
Like 10%.
No, it's when everybody's on X saying,
yeah,
celebrating each 1,000 rise,
yeah.
Bitcoin feels great at 150,000. I wonder how 151,000. When everybody's doing that kind of stuff, you kind of know that we're getting a bit effervescent. But also, when I look at it in macro terms, is all the macro tops have come with business cycle tops through the business cycle low. They've all come with liquidity tops, liquidity's expanding. And then when you look on a forward basis, we've got the government shutdown to reopen. That's going to open $1 trillion of flow out of the Treasury General account. We've got Fed rate cuts coming. We've got the changes to the SLR, which is the minimum requirements for banks. We've got potential balance sheet expansion coming. We've got China expanding its balance sheet. We've got the Trump tax cuts to come into place. We've got, the list is endless of liquidity that's to come. And we've got to roll $10 trillion of debt. So my view is we had this extended year, which was this year, because they didn't need to roll the debt because the debt got matured to 5 years. So we just had ongoing liquidity. And I think 2026 is going to be a banner year.
Can I ask? Because
I still think the end of this, I think November, December are going to be very strong here as well.
AI.
Well, within like Real Vision Pro and GMI, we've had tons of tech stocks. So we've always said my personal portfolio is much more skewed towards crypto, but the portfolio there has been, we've had I don't know how many stocks we've had up 100%, 200%, call options up like 300-400%. It's been a stupid easy environment in tech. But yes, the decoupling of NASDAQ from crypto has been interesting, but I think it's explainable. So normally you need to figure out why something is happening and is there real signal there? So one signal may be crypto's topped and everything else is going to fall afterwards. I get it, but I would give that 20% probability or 30% probability versus crypto's being affected by liquidity at the margin because it's the most influenced by liquidity. And when it comes back, it plays catch up. So the alligator jaws get close to the upside.
Do you know what I mean?
Right. That's right. And you at some point the NASDAQ will need to correct, but structurally, and there used to be a hedge fund who was one of my clients based out of Miami. Every year they come on with the same trade, and every year it worked. And that trade was around about now. They come and buy call spreads and sell downside puts in every major market because the year-end rally effect is real. And sell some puts to make it a really cheap trade to do.
Yeah.
So, a trade that normally, had you just bought calls, they would have cost you, let's say, 50 cents. But if you do a call spread, it's now cost you like 10 cents because you've capped some of your upside. And then you sell some puts at way out of the money for 5 cents, and the whole trade costs you 5 cents. And then if it does go up, you made like 20 times your money. And they did this trade every year. And it works because the seasonality is so strong at the end of the year. And when you've got a year like this one, where we've got liquidity that needs to come into the market, but more than that, everybody's underweight tech. I mean, the surveys come out from like Bank of America all the time. It's like everyone's underweight tech. And so we know the year-end window dressing means I need to buy tech. How I think of it is the market's short the upside calls, right? It's like the moment the market goes up, they all have to buy. And because they've got this mental thing that they could buy it lower and they can't, it's like that creates a great market. That is interesting. Actually, I've got a call. Barry Silver reached out to me and said, let's talk about it. I want to know more about the Zcash thing. I think I understand it. It's a very clean narrative, and Mert has made it very clear on why. And I think, yes, but do I want to deal with the volatility and the speculation at this point for the privacy? It's like, do I want the investment or do I want the privacy? I'd rather have the privacy than the investment right now because I don't know. And we've all had our hopes and dreams in Zcash a few times and it then fails. So
I was going to say, because it must have been around the last couple of cycles that you've been.
Yeah. And it's always been interesting. And the other one that's been on my radar screen, again, because Barry mentioned it, and is
Tau?
Tau, yeah.
Yeah,
like,
I'm pretty big in Tau at the moment.
And that the long-term chart looks good. I mean, Tau looks interesting. Now, I don't hold any of it, but yeah, those are two things that I would say are interesting.
I've been very interested.
I've done nothing. The only trades I've done the entire year was I bought some more in April, and I bought again last week.
The cryptocurrency community is exhausted. On X, people are arguing, questioning their decisions, and wondering if they chose the incorrect market to support. This dissatisfaction is actually a classic bottom signal, or what Raoul Pal humorously refers to as his monkeys throwing poo indicator. This type of emotional upheaval, in his experience, usually occurs just before a turning point. According to Pal, the dynamics are straightforward. Everyone is attempting to advance. Instead of riding Solana, investors are comparing themselves to those who rode NVIDIA. Due to the ease of investing in stocks, hedge funds are returning to them. That's precisely what extended consolidation periods look like: irritation, impatience, and jealousy. Pal contends that because the foundations are flawed, cryptocurrency isn't behind. Because liquidity has momentarily vanished, it is lagging. Crypto is not supported by required allocations or passive inflows as equities are. Everything turns flat when the liquidity stops flowing, and prices retort forcefully when liquidity returns. The Treasury General Account is currently storing around $1 trillion. Stablecoin growth has slowed, and reverse repo markets are essentially barren. Money has been pulled out of the cryptocurrency economy by all of that. Pal, however, sees this as a setup rather than a bearish trend. He anticipates a significant spike in risk assets once the government completely reopens and liquidity begins to flow once more as a result of Fed cuts, SLR adjustments, and additional fiscal expenditure. He adds that the same people who are criticizing cryptocurrency will be the ones pursuing it when it happens. He doesn't see this as a collapse. The crypto industry is simply going through a slow period. Additionally, the assets that have been frozen the longest, like as Ethereum and Solana, may rip the hardest when liquidity returns.
So stablecoins add value to the network layer because you're transacting either small or large transactions, right? Tether does huge transactions, and that gives Tron its value. There's no other value to Tron except the fact that this massive network keeps transacting enormous volumes on it. So I do think that there's plenty of long-term holders of these underlying assets and they want to do stuff. Like in equities, you can lend your equities out into the loan markets or you can borrow against equities. It's the same thing. And we've got that in, but right now people don't have a lot of money. And so you kind of make a choice. So if you look at it across the board, it's telling you there's no money flowing in. Look at the growth of stablecoins. It's been stable since the summer, right? So we've got no money coming into the crypto economy. So over time, people need to pay bills, realize stuff, and foundations need to sell tokens and all of those things, and the number go down because we've not had liquidity in the crypto economy. So I just don't want to confuse that with it's the death of layer ones. It's nothing's going to work. DeFi is not going to It's like, no, it's just a slow economy right now in crypto land. We've gone through a slow patch. That's how I think about it. I think the big ones know what they're doing, and the smaller ones could get messy. I mean, I've never liked this DAT trade. In the end, a few people will figure it out, but it's so complicated. If anybody can understand the capital structure of MicroStrategies without some PhD in nuclear physics, I mean, it's so ridiculous. I just think there's no such thing as free money generally. And as soon as people think there's free money, everything goes to shit. And
you were never approached by that. I feel like you would have been one of the first
approached
by some of these. I got
approached by outside of the ETH and MicroStrategies. I got approached by pretty much every single one.
Yeah, I can imagine.
And to lead them, and I'm like, I'm not going on the board of a US company. I live in the Cayman Islands. It's tax free. I'm not doing that. And also, I'm like, I'm not really comfortable with these. Now, again, they're not terrible and people will figure it out. But I think we have to go through some pain in these. But also the DATs are showing you there's not much money flowing into the crypto economy either. So the premium ability has gone down as well. So it's telling us something about liquidity flows in markets. I had a thesis from the last cycle that this cycle would end up having a shortage of ETH. Because of the burn mechanism. And then if you start locking up ETH like this in vehicles that aren't going to sell very quickly, you end up with a shortage of the stuff. So it gets very convex. So it feels like it could do that. It kind of breaks 5,000 before it's trading 10 in like a month. So 10% moved it. Put the percentages on from the bottom to the peak.
Yeah, to be fair, it did from around the time we started to see big ETF inflows, which is around 1,500, I would say. So it did do about a 3x.
So a 3x, so 300%. So there's your gearing, right? 10%, and you accumulate 10%, the market goes up 300%.
200%. Yeah.
200%. Yeah. Know what a supermassive black hole crypto is for investors the moment it starts really accelerating. because the returns dwarf even the tech stocks, and it starts sucking capital in. All of the traders come back from trading equities. The equity guys have their eye on crypto, and before you know, and now they've got ETFs to trade. It starts becoming a much bigger thing. I do think we'll see that reversal of attention, because the markets can only carry so much attention with only so much money in the market right now. I feel like gold's going to go again.
I love gold. I think gold's trading going higher.
Yeah, I think it's going to go higher. And I think of gold as Bitcoin 6 months ahead. And if that is the case, if that continues, then the higher gold goes for longer, the further the rally extends into next year for crypto. That's how I look at it. The community, there's so many curmudgeons in it. That's the problem, is like
curmudgeon. What? I've never heard of that before.
Curmudgeon. It's like miserable old gits.
Oh right, yeah,
angry old man shaking fists at sky. Peter Schiff. I mean, basically that, and it's full of them. But you're right. Gold does a job, which is to maintain store of value over time, and it's done it brilliantly. You know, it basically rises with the amount of debasement of currency there is on a global basis. It's very misunderstood. When we talked about the banana zone, we said, right, okay, the phase 2 starts. It started in April, and it went up. Everything doubled or tripled from then, and then pulled back. And we've got this weird liquidity period. I just think nothing changes. The market, I'm very bullish. I think it goes up a lot over the next 12 months based on liquidity in the everything code framework. And so nothing really's changed for me. The only thing that sometimes changes is time horizon. It's like, well, I didn't expect the government to shut down for the longest period in history, but we've got to deal with that. And that means they can't draw down the TGA. Okay, we need to deal with that. But other than that.
Raoul Pal's paradigm compels you to look past the weekly commotion and consider the market through the lens of global liquidity, which is the true impetus behind all significant asset booms. And the current standstill appears less enigmatic when you look at cryptocurrency that way. China is growing its balance sheet. The U.S. has $10 trillion in debt that is about to mature. The Fed is getting ready to change course, and the Treasury is getting ready for enormous expenditure. All of that suggests to Pal that a massive surge of liquidity is imminent. He believes that the joyful, vertical portion of the cycle, known as the banana zone, hasn't even started yet. The market is currently preparing for its next big parabolic move during the patience phase, which is a tranquil period during which conviction is put to the test. If he is correct, the greatest profits will come from knowing how liquidity cycles operate and maintaining your position before the flood comes, rather than from attempting to precisely time declines. The question then becomes, is this optimistic thinking in a tired market, or are we in a stretched cycle that peaks in 2026? Please leave your comments below, and if this breakdown was helpful, remember to like, subscribe, and forward it to someone who is experiencing a loss of confidence. This journey is far from over if Pal is correct.